We have an incredible global family, and I would like to thank everybody who watches and comments. I was very touched by Daryl's comment, and I decided to do a different video from the video I had intended to do today, to help Daryl and people like Daryl to get more in synchronization with the market. This video is concentrated or focused on what Daryl is talking about. To start with, I need to give you the aerial view before we dive in. I expect that answering this question will take many videos. If you're struggling and not making profits, this particular video will really help you out. So sit back, relax, and enjoy. This is a long one, but it's very, very valuable. And it's made especially for Daryl and people like Daryl who are going through losses and not profits. If you have other topics that you would like me to talk about, please leave a comment. Let's get into it. Hi everyone, I'm Ken from Crypto Trading KS. Here you'll learn so you can profit like smart money. If you find the content helpful, don't forget to smash that like button and subscribe. Let's run the numbers. In the past trading session, Bitcoin has come up 1.56%. The greatest gainers in the past 24 hours, top 100, eCash, TON, GMX, CFX, GRT, NEO, LEO, Matic, and Curve. The greatest losers, top 100 past 24 hours, Nexo, Rocket Pool, Ethereum Classic, HBAR, Tether Gold, Aptos, FRAXshare, and USDP. When people first start trading and investing, they're looking for any rocket ship to attach themselves to. That is, they'll frequently look to the greenest of green on all the maps. They quickly find that the problem with very, very green tokens is they're green until they buy them. And then typically that particular token will just start to crash. A more effective way to increase your profitability is to first focus on not worrying about the green ones. Just limit your universe. Just focus in on a few tokens. That's why Tier 1, Tier 2, and Tier 3 analysis is so incredibly important. It takes a while to learn Rule 446. All markets are intercorrelated and interdependent. These Tier 1, Tier 2, and Tier 3 charts all reinforce each other. A very powerful way to start your assessment of the market each and every day is to determine where are the markets going. If we look at the S&P 500 futures at the moment, we can see that we've got a bit of wobbliness inside the market because we're leading into the FOMC meeting. Sometimes you've picked correctly, but the problem is your timing is out. We can see that the S&P 500 has come down recently, and that's been reflected into the Nasdaq, into the Dow, and into the Russell. The US markets are the heavyweight markets of the globe. If the US markets are coming down, you've got a greater probability that other regional markets are coming down as well. This is a very important factor to understand. For example, if the S&P 500, the Nasdaq, the Dow, the Russell, and you can just focus on the S&P 500 and the Nasdaq, if they're coming down, you can pretty much bet that Australia's market is coming down as well. For example, if you're in Australia and dealing with an Australian stock, and you're not keeping your eyes on the US stock market, you're already running the risk of getting mistimed. For example, if you saw the S&P 500 and the Nasdaq start to break below structural support levels, you could bet that the ASX and other major indices weren't far behind. That would directly impact what you're investing or trading in. How can you tell if major indices are strengthening or weakening? One thing that you do is you look to the yields. We can see that the US 2-year yield is currently strengthening. Also, the US 10-year yield is currently strengthening as well. When the yields come up, it means that interest rates are coming up. When interest rates come up, people get freaked out, so they put their money into cash. That's what the DXY is measuring. And we can see the DXY is measuring positive momentum. This means that there's always asset allocation. and risk management occurring inside the market. We can use other currency pairs to try to figure out where the DXY and yields are going, and we can see that dollar-yen is confirming DXY strength. Euro-dollar weakness is also confirming DXY strength. This gives us an insight into risk allocation, and one thing we're noticing inside the major indices, the stock market is getting a little concerned. With knowledge, we can apply Rule 621, buy on red, sell on green. This puts us on the right side of the percentage and allows price fluctuations to move in our direction for our profitability. But it's hard to do, and your mind will just think, oh no, when it goes red I should sell, and when it goes green I should buy. Doing that will place you always onto the wrong side of the percentage and limit your profitability and success inside financial markets. All investors become traders anytime they buy or sell, and all markets are slightly different. The commodities and Forex and crypto stock market, they're all different. Yet they all have the same commonality, they're measuring risk. When you look at a specific chart, it's important to understand where structural resistance levels are and structural support levels are. When you know where the structural support is, and that is a smart money buy level beneath the current price. Resistance, structural resistance. And the key is to understand there's a difference between retail support and resistance and structural support and resistance. We use the CTKS method to determine where structural resistance is. Why do we bother with this? Because structural counts. You can see as total crypto market cap came up to structural levels, it's been rejected, but it's starting to find a consolidation base. If we can get above this particular level, it means that we're moving forward. Now, why do we even look at total? You may be investing and trading in Solana. So you might say, oh Ken, I don't really need to look at the stock market. I don't need to look at Forex. I don't need to look at the yields. I don't need to look at the US and the 10-year and the DXY. I don't need to look at any of that. I'm just going to look at Solana. That's a huge mistake. Because all charts are intercorrelated and interconnected. We can see when we overlay Solana, when total crypto market came down, Solana came down. When it started to recover, Solana came up. When total crypto market cap hit resistance, Solana came down. When it found structural support, it rebounded and came up. Knowing how the market is moving is incredibly important. You need to focus on your synchronization. It takes a while to get synchronized in with the market, so just go slow to go fast. It's all about knowledge. And when we look at Bitcoin, we must understand where the structural support and resistance levels are. And we can see Bitcoin currently trading at 27,182, has a 27,232 structural resistance level above it. If Bitcoin can manage to get above this level, we could see fireworks in the crypto market. But we always do three-dimensional risk management. We just don't ascribe to one potential probability. And you can see Solana's chart overlay here. It's been following Bitcoin quite well, but you'll notice a divergence between these two peaks. Bitcoin's peak and total crypto market cap's peak is higher than Solana. This means that people are getting a little concerned about Solana. Potentially, there's a flight to safety across the alts into Bitcoin. Why is this? To answer this question, we need to go back to the main markets. When main market indices come down hard like we've seen with the S&P 500, the Dow, the Nasdaq, the Russell, what typically happens? You get a flight to safety into the big names. People are concerned about rising oil prices and the inflationary effect they could have on yields. That's why we're seeing the 2 and the 10-year come up and the DXY strengthening. As the markets get concerned, gold shines, and silver can shine even more. Growth concerns and economic slowdowns inside China are driving copper's price lower. Due to the pandemic, central banks flooded the system with money. This occurred all around the world. To stimulate economic activity, we saw dramatic increases in the amount of money that was flowing around all the world's economies. This sent interest rates spiraling towards zero, in some cases negative. Now, the central banks are restricting that easy monetary policy. That's causing interest rates to go up and people to do risk reallocation. The central banks did this because they needed to avoid another Great Depression that the pandemic induced. The markets have become addicted to easy money. They don't like it when restrictive monetary policy is at hand. We can see the restrictive policy inside the US. We can see it inside Germany, inside Australia. That's not the case inside Japan and China and New Zealand. But it is the case restrictive monetary policy inside the UK and China. Japan and China are trying desperately to save their economies at the moment. That's why they're pushing money back inside the economic systems. When the pandemic hit, central banks all around the world just pumped their balance sheets and they lowered interest rates literally to zero. You can see in Japan, it's been a flat line, negative 0.1%. What central banks do is really important to the stock market, to commodities, to crypto. And we can see that China has been reducing the interest rate gradually since the pandemic. This is to stimulate their property sector. When the central banks increased interest rates from virtually 0%, from virtually nothing, to huge amounts, what happened was that the people who borrowed money simply couldn't afford to pay it back. This has led to a string of US bank failures. Also, people are getting really concerned that the US economic systems and the Euro system are subject to increasing turbulence. This is making crypto really interesting for people, but not for the banking system. For the banking system, crypto represents a leakage outside their control, and therefore they're bringing heavy regulation on it. Increasing institutional interest in crypto is just everywhere. In the news, in the past 24 hours, BlackRock news rumors of a 12,200 Bitcoin purchase shaking up the financial world. Always remember, rumors are rumors until they're proven otherwise. Citigroup announces blockchain to service institutional clients. Recently, Chainalysis released their 2023 Global Crypto Adoption Index. And what do we see? Who's ranked number 1? India. What about number 2? That's Nigeria. And number 3, Vietnam, followed by the US. There's a lot of money flowing into the crypto space, and it's got the central banks really worried. Blockchain Capital raises $580 million for new cryptocurrency investment fund. Bear markets and bull markets don't last forever. There is news coming out that certain websites are seeing increased traffic in the crypto market. Crypto is a global phenomenon. Taiwan calls El Salvador authorities to establish a virtual assets bureau for enhanced crypto regulations. Meanwhile, the New York state regulator proposes tougher guidelines for crypto listings. The Securities Exchange Commission urgently calls for the inspection of crypto exchange Binance.US and the resignation of the CEO. And they get denied. The SEC sees a temporary setback in the request to access Binance.US software. Crypto and crypto regulation is everywhere. South Korea focuses on over-the-counter crypto regulations, or OTC, as unlawful deals reach $4 billion. Always remember the deeper picture here. Central banks need to control their balance sheets. They need to control the on-ramps and off-ramps of money. If they don't, they can't affect monetary policy. What is the best way to control crypto for government? Just not deal with it at all. Crypto regulations are becoming increasingly political. Senator Warren's crypto money laundering bills build momentum as more sign on. The interesting thing with here, Crypto leaves an indelible or unchangeable fingerprint. For criminals to use crypto, they have to be pretty stupid. These headlines, when I read them, I say it's all about the banks. Not all government officials are myopic. It's difficult to believe, but when the internet was first gaining mainstream traction and success, the governments tried to ban it. I know that from first-hand experience. I was operating an internet service provider back in 1993. Hester Pierce, one of the commissioners for the Securities Exchange Commission, says crypto firms shouldn't give up on the US. We're seeing an increasingly divided world. Hong Kong regulator hosts top Ethereum researcher Justin Drake and asks him to extend an invitation to Vitalik. The governments control the money supply, and you've seen by those charts, it's important for them to do so. They don't need some upstart thing like crypto getting in their road. And unfortunately, crypto has had their fair share of scammers. FTX bankruptcy estate sues Sam Bankman-Fried's parents, Joseph and Barbara, to claw back misappropriated funds. Bad actors are everywhere, and especially in markets that have hundreds of millions or billions of dollars of inflows. They want to pocket them. It's utterly no different inside the main markets. Professionals know that all markets are intercorrelated and interdependent. They're just a place that people put money for a return, given a specified level of risk. It's important to know the crypto market is incredibly risky, but that's how you make big returns. Zero risk, zero return. The reason that I'm giving this background information is it's really important to understand the why. When you understand the larger picture, things will start falling into place. The veil will be lifted, so to speak. But it does take time. Just go slow to go fast. Keep your eye on Bitcoin if you're in the crypto market. For example, when we look at Bitcoin's price and we can see it's looking like this, and it's starting to come down. The question is, when people get into a situation when they look at price like this, they just think that the price is going to fall to zero. That's not correct. The price will fall to a structural support level, and we had one of those at 27,047. And then what happens? It found that structure and it reversed. All of this has occurred during the recording of this video. That's why it's so important to know where your safety nets and ceilings are. Continuing on with Bitcoin, a lot of people get into the habit of seeing when it's green, everything is fine, but when it's red, everything is disaster. The key is to invert this method of thinking. When you see red, get excited, but get excited around structural levels. For example, if you were looking at Ethereum trying to figure out where to get in, where to get out, the key is where is the structural levels inside Ethereum. You can see one level of structure is this 1624 level. Then you come up to overhead structure 1644, overhead again 1651, and resistance, structural resistance at 1652. You know that price is always moving SL to SL. If you get a confluence of SLs or Stanfield levels, what actually occurs is that there are a lot of sellers if price is below those SLs. If price is above the SLs, that's what you want. There's a confluence of buyers there. The key to understand is momentum. It takes a lot of momentum to get through these overhead barriers. Frequently, it just exhausts the buyers. And when you see these long tail rejections, that's actually what it is. It's a rejection. The buyers pushed it all the way up, but the sellers said, you're not going up there, and pushed it all the way back down again. So when you see these tails poking up, that's giving you an indication that the buyers want to take it there, but the sellers don't want it to go there. Always remember, price is always moving in a wave. It's always going up and down. XRP is currently doing really well against Bitcoin, but where is the structure inside the market? We can see a lot of overhead structure here, a lot of strong resistance levels above. A lot of people think when they just join the markets, there's only one level of support and one level of resistance. This is not the case. Just think about market structure in terms of safety nets. For example, there are a lot of sellers up here for XRP. If those sellers gain control, they will push the price down. Where would the price go to just naturally? It'd go to around this 50-50 mark because there's structure there. And the next level down would be 49.12. These lines have been marked up with the standards-based methodology since 2013. They're not regular support and resistance lines. From yesterday's video, Cheryl said the SLs, these Stanfield levels, or these lines, and you can see there a variety of different thicknesses. They're like a roadmap guiding your steps. XRP is doing well, but we know there's overhead structure there, so we may get a pull back before getting above this. It would be better if all of this structure was actually support below XRP's price. When you get a lot of overhead structure like this, it typically takes a while for price to get through those levels. And we see this time and time again when we look at the Tier 1, Tier 2 and Tier 3 charts. In yesterday's video, Tales from the Man Cave said, it takes some time getting used to selling at small percentages. In fact, I still get tempted to seek higher gains on a single trade. The key is to look inside the market structure. When we look at ADA, which has been marked up since 2017, we can see that there's strong structural resistance at that 2460 mark. There's also strong structural resistance at 2468. We're starting to come into resistance at 2568 and higher at 2576. But if you note, this move from this cluster of SLs up to this one is nearly 5%. Retail is sold on the concept that you must make 10x, 20x and 30x gains all in one hit. Professionals would never ever think that way. Yesterday's video was all about showing you how to get on the right side of the percentage, which is the annualized return on investment. Please have another look at that video. It has some real gems inside it. Tales also said, but looking back at the numerous trades I got stuck in over the last 2 years, it becomes obvious that I would have done so much better taking small profits and recycling my money. Well done on your trades yesterday too, Tales. Mindset is your greatest enemy or greatest accomplishment when it comes to financial markets. If you do your trading and investing based on fear, you will find that your fear comes true because that's the way that fear works. Fear is always a self-fulfilling prophecy. Just understand the price is always moving in a wave. It's moving between structural support and structural resistance levels. If you understand this, you're going to do incredibly well. But you also need patience. Patience is profitability. There are two methodologies of thinking inside financial markets, Zone 1 and Zone 2 thinking, which is called retail thinking, Zone 3 and Zone 4, which is called smart money thinking, or professional thinking. Inside Zone 1 and Zone 2, people lose money because fear is guiding their decision-making process. People are very fearful when it comes to putting money into a trade or investment. Money is very hard to come by, so when people see a paper loss, they get freaked out and they turn it into a real loss by selling. I've been inside financial markets for nearly 4 decades, and what occurs inside Zone 3 and Zone 4 is completely opposite to Zone 1 and Zone 2. Zone 3 and Zone 4, when you see the red, you get excited. You want to buy on red. You say, about time. The other thing to note, inside Zone 1 and Zone 2, people think that in order for them to profit, another must lose. That's not how financial markets work. Zone 1 and Zone 2 think it's a zero-sum game. If I win, you lose, and if I lose, you win. No wonder there's so much panic and so much blame and conflict inside these two zones. Zone 1 and Zone 2 are literally survival zones. People are fighting for their life. And they're doing so with free content from the internet, free content put out by Zone 1 and Zone 2 people. People without real experience inside financial markets, understanding how things actually work, and it takes decades and decades to get that knowledge. The reason for that is you basically have to unwire and rewire all your emotional circuitry when it comes to making profits inside financial markets. People talk about blowing up their accounts inside Zone 1 and Zone 2, and they do it repeatedly. That's because their emotions are in control and their knowledge is very low. And even if they have high levels of knowledge, it's the wrong knowledge. Retail knowledge is Zone 1 and Zone 2. It will decimate your portfolio. Eventually, people throw up their arms and say, enough. I've had enough of being inside Zone 1 and Zone 2. And every single profitable investor and trader goes through Zone 1 and Zone 2. The key is learning, but it's the right type of learning. Learning what the professionals do. And the professionals do things that retail and amateurs just simply don't do, and they would never think of doing them. That's what makes them professionals in the first place. Zone 3 and Zone 4 is where you master fear and you master knowledge. You look and say, yeah, I can see this person knows retail, but they don't know professional level knowledge. The easiest way to spot Zone 1 and Zone 2 influencers is to simply look at the thumbnail. It goes something like this: from $0 to $200 million. What I did to make this profit. Just guess what? You can't make anything from nothing. If you have $0 and you compound it at 1,000,000%, you still have $0. If you start with nothing, you'll still have nothing. Please beware of those thumbnails. You're getting conned. It takes time to be a professional, and professionals go slow to go fast. Whatever you can do to move away from retail thinking, Zone 1 and Zone 2, into professional thinking, Zone 3 and Zone 4, is incredibly important for your account balance and your emotional sanity. Always think, if you're not getting it right, what can you do to improve? What in here on the professional side can you do? And what can you stop doing on the retail side? Fear is always the driving force behind retail, knowledge the driving force behind professionals. Fear is inversely proportional to knowledge plus experience. If you need to get rid of fear, which we all need to get rid of inside financial markets, raise your knowledge and make sure it's professional knowledge and not retail knowledge. Also, raise your experience, and don't raise your experience by going all in and more under heavy leverage. Do the exact opposite of that. Put coffee money into a trade at SLs or structural levels. Then analyze those trades, feel the emotions that you're feeling, and then short circuit them. Do your three-dimensional risk management, and if you're buying at levels of structure, this is already taken care of, because you know what you're doing and you know where the smart money is buying and selling. We've covered a lot off in this video. We've looked at how the major indices get impacted by the 2, the 10, the DXY. We've seen the crypto is incredibly risky, but that's where the returns are. You have very powerful information and understandings contained within this video to help you to understand if the central banks tighten, what could that look like, and what could happen to interest rates, and therefore risk allocations. Being a professional means that you have high levels of knowledge, you have your three-dimensional risk management, you know the structure, you're going slow to go fast. That's why it's critical to look at the structure across the Tier 1, Tier 2 and Tier 3 charts. As you saw earlier in the video, they will all confirm each other. As a professional, synchronization is everything. It does take time to get synchronized. On your path to synchronization, it's very important that you be kind to yourself. Focus on your learning. If things don't work out, focus on what you can do better next time. Every loss has a lesson within it. You need to extract that lesson because you paid for it. Have a great day or night ahead, my friends, and Kate and I look forward to catching up with you again tomorrow. Bye for now.